Most people think they are saving money when really they are just letting it sit and lose value. Let's fix that. Welcome to day 12 of 30 Days to Graduate in Financial Literacy. Everybody knows that if you want to save money, just take your money to the bank, right? But there are a lot more options that you might not be aware of. Here, let me show you what they are so you can choose what's best for you. Number 1, we have the checking account. This is used for daily spending with interest near zero. This account is good for paying bills and holding cash temporarily, but not to leave large amounts of money because you will end up losing money to inflation. Next, we have the traditional savings account. That is to use for your emergency fund or short-term goals. Although the interest you get is around 0.01 to 0.1% at big banks, which is terrible. Then we have high-yield savings accounts, which you can use for your emergency fund or short-term savings, with a rate of return of 4 to 5%, which is much higher than at the bank. Although this type of account can only be opened online, and transfers may delay 1 to 2 days. Then we have certificates of deposit, also called CDs. The way they work is you agree to leave your money at the bank, locked up for a set term, like 6 months, 1 year, or 5 years, in exchange for a guaranteed interest rate, usually higher than the high-yield savings account, but still less than investing it. And you cannot take the money out before the term ends, or you get an early withdrawal penalty. Then there is a money market account, which is a mix of savings and checking, with unusually higher interest rates than regular savings. It's best for people who want some access, but slightly better growth, although they have higher minimum balance requirements and limited withdrawals per month. And this one is not to be confused with the money market fund. Lastly, we have investment accounts, and they are important once you build your emergency savings. They are for long-term growth, not a place for your emergency fund. This includes brokerage accounts, 401ks, IRAs, but we will talk about that in more detail later on. Now I know, that's a lot of options when it comes to saving, and one can easily get lost. What I normally do with my clients, I sit them down and help them understand that there are 3 types of accounts a person should have: an emergency account, a short-term account, and a long-term account. The emergency account, your goal should be to have 3 to 6 months worth of savings. And that could be put in a regular savings account. It's for unforeseen events that might happen, like losing your job or your car breaking down. Your short-term account is for purchases you plan to make in the next 3 to 5 years, maybe like buying a car, down payment for a house. And that money should be invested, where you have a higher chance of earning a higher rate of return. And your long-term account is simply for your retirement, something you don't plan to touch 30 years from now, and should be all invested in things like mutual funds or index funds. If you found this information helpful, save it for later or share it with a friend, and I'll see you tomorrow for day 13 of 30 Days to Graduate in Financial Literacy.